Good morning, folks. Good morning. Just going to be doing an audio check here in a minute. Try to see if I can hear myself. Audio check 1. Audio check 2. Okay, yeah, we're good. I can hear me. I can hear the old man. All right, so premium gap opening up here. On the 50-minute time frame, you can see we bumped this high. You see that here. And on a 1-minute chart, I was telling my son, who is, good morning, Caleb, how are you?
I'm doing great.
All right. That's a pretty good bench with some map, isn't it? Yeah, I got a comment saying that there is no Caleb. There is no Caleb. All right, so south side's been taken here. We want to see, does it have an interest to erode further, or if it wants to bang around inside this range. Admittedly, I'm a little prepared, let's say it this way. I'm prepared for it to be a rather lackluster morning session. And I'll go into detail as to why I believe that once we get a little bit further into the opening range. Right now it's 931. 930s. SIBI here, we're not factoring that. Caleb's got to use the first fair value gap. That could only form as early as 931. So while, yes, we are aware that that's there, I'm teaching him to use the one that forms at 931 or later. For the folks that are comfortable with using the 15-second time frame, you may note that there's a gap here that's still inside the 930 minute. So it's good to note it, but it's not what we're using today, okay? Right now, the left chart, Caleb, is 1 minute, but it's showing electronic trading hours. So that time begins at 6 p.m. Eastern time, and it trades until 5 p.m. close today, which closes the week, but also closes the session for 1 hour. If we traded on Saturday, which we don't, it would reopen at 6 o'clock. But in this case, since it's Friday, electronic trading hours will close at 5 p.m. today and then won't open again until Sunday, 6 p.m. Eastern time. But the regular trading hours here I was showing you before the stream started, and they're all familiar with this. The 414 from yesterday to the first opening price here, there's a 70% chance that the market will come back down and trade half gap. So that's consequent encouragement of the difference between yesterday's 414 settlement price, which is regular trading hours, and you always have to make sure you're looking at the right one. In the morning at the opening bell, if there's a gap, you'll see it'll look totally different in terms of the chart on electronic trading hours. But the settlement price here, the close to the opening price at 930, that's the opening range gap. Opening range is time between 9:30 a.m. to 10 o'clock a.m. So that 30-minute interval, the algorithms use that as a kind of like a preliminary range to establish, number one, the first imbalance, initial highs and initial lows, and then you use that information to build a narrative on how the daily range will build, whether it be a bullish day or a bearish day. We're not trying to predict the closing price. I will be teaching you that but it's not here today. It's not, we're not in that yet. You have other things to worry about first. All right, so we have that, and now I'm going to add the quadrant levels as well. And you simply just do this. So now you have the opening range gap levels. We can go back to electronic trading hours. So now we have our key levels. Sell side's been taken. So there is buy side resting up here. And we have minor sell side now at the low that's formed. So far on the 1 minute chart, we have no inefficiency except for the 930 candle. Still useful, but for your model, you have to use the next one after that 931. 931 starts your seeking of a fair value gap. You might think, well, Dad, why don't I just use this one, right? Because it's there. Well, because you're referring to the opening range gap, and because there's a lot of volatility that can come into the marketplace because of a gap, or because the gap may not be that significant, and maybe a small gap. In this case, we've had a little bit of it's not a big gap. I would have rather had a larger gap between its low and its high. So in other words, yesterday's 415 or 414 settlement price on a 1 minute chart versus the 931st printed price today. We want something ideally more than 40 handles. I personally like something that's closer to 75. I know that the range is going to be very. I mean, this is your fair value gap right there. Okay. So that's the one you would put out into the future with extending it into the right. And we'll just keep it gray for now. So today's Friday, and since we've had basically an up session every day this week, TGIF is a factor where you see these relative equal lows. That's your draw for sell side. Okay. Now just be mindful because I'm going to scroll the chart over so you're not going to see this. I'm just focus on the price action over here. But this right here is what we're looking at. You understand?
Yes.
So because it's Friday, because we had a premium gap opening, because we have left that gap to the downside and traded below it, it could be viewed as kind of like an exhaustion gap, meaning that we gapped up there at the open of the session today, and then it trades down, fills the gap, tries to rally, and then folds and goes lower. So we can now use the low of the gap as a means of treating it like a fair value gap. In other words, if it trades back up into it and it struggles to get into it in any degree, and if it starts to roll over and trade lower, then we can use a subsequent fair value gap, a very small short-term swing high to be rated for like a turtle suit where it just goes and gets a short-term liquidity and then bang and drops lower. TGIF, because we've had an up week all this week, 20% to 30% of the weekly range is usually what I like to see. It doesn't need to do it. If it doesn't do it today, then usually on Monday, you'll have some kind of a retracement into that previous week's range. to the amount of 20 to 30%. All right, so we're inside that fair value gap here. And scroll down here. So the setup, running back into this gap here, you're going to study how it behaves here. From this fair value gap down to the liquidity, it's been noted with these relative equal lows right there. This settlement price here, I'm going to just put a box on it because I want you to see the color difference in terms of like a range. And we'll do this. So what I did is I noted yesterday's 414 settlement price up to today's opening price at 9:30. So when you're using regular trading hours, it's not going to plot any of the price fluctuation between those two times. But when you go to electronic trading hours, you're going to see that there's been a lot of trading since those, it's been doing a whole lot more, right? So because now we can see we gapped open higher with this price on this candlestick here, and the low of that shaded pink area, that's the actual gap between yesterday's 4:14 p.m. Eastern Time settlement price to 9:30's opening price today. So that gap, we opened here, which is a premium. It sold off, came back up, and then left the gap. You see that? And then right here, we hit it at the low of that pink shaded area. But it's also consequent encroachment of that first fair value gap of the day. See that? See what it did there on this candlestick right there hitting it?
Yes.
Okay. So we would want to see, does it have the ability to want to, or an interest to reprice down to the sell side from there, because the underlying dynamics are, it's Friday, it's been going up all week long, it's healthy for it to go down there. Even if it wants to go higher, it can go down there and pick up the stops where they can buy from someone that wants to sell to them at a cheap discount price. So if they can see that there's relative equal lows down there, retail traders would see that as support. And we like to look for areas where we can scoop up sell stops or short buy stops. And if you start blending these things together, you can kind of like flesh out a narrative where not just one thing is leaning on the basis of why you're taking a trade or why you expect the price to move a specific way. There has to be at least 3 factors there. And one of the main things is time. There has to be a reason for it to move based on time. And if you trade outside of the trade setups that are not factoring heavily on the element of time, you can still get setups, but you're not going to get that institutional sponsorship that comes with the moves that usually are delivered by a time-based mechanism. Like the first 10 minutes before you get to the top of the hour, so 9:50 to 10 o'clock, that 10-minute interval, and from 10 o'clock to 10:10, that interval is 20 minutes in interval. So that's a macro. So usually the algorithms will start firing off and it's spooling price to run to an inefficiency above or below the marketplace, or it's running to liquidity above an old high or relative equal highs, or below an old low or relative equal lows. So if you have these expectations on what price may do around that specific time, even if you don't have a bias, you can go in and watch the first few minutes of the day, and then not all the time, and this is a skill set you'll develop as you do more of it, watching price and studying, but you'll discover that you're learning how to discover the narrative for the morning session. You're not trying to predict the daily candlestick right now, but you're just trying to get a feel for what is the most likely probable outcome based on where we opened up at 9:30 relative to where we closed at 4:14 yesterday p.m. regular session hours. Where is the liquidity? Why should it be interested to go higher, or why should it be interested to go lower? What liquidity is there? Is it relative equal highs there? Is there relative equal lows there? Is there a large inefficiency above the market price? Or is there a large inefficiency below the market price? So these are all questions that I ask myself There's very specific things, and the times when you're watching price where it is so heavily handed on one side of the marketplace, where it's hard to argue the position from a buyer's perspective or a short seller's perspective. If you can justify the trade or the idea of what you think the market's going to do at the given time while you're looking at the price, if you can justify it on both sides of the spectrum, being a buyer or seller, that's not high probability. Would you agree?
Yeah, I would agree.
So would it not be advantageous for you to focus on days and times when the market is presenting suggestions that the market would want to go lower because less informed traders that use concepts like support and resistance, if they see a level that's too smooth above or below, it's natural to expect that there'd be orders below or above those highs, right? Or
Yes.
below those lows.
Yes.
So if we know that that's the case, we don't need a book map. We don't need any kind of application to kind of like draw some special attention to it. We can clearly see and read the chart like anybody else would. But you have to put yourself in a position that a retail trader doesn't have. Most times, they don't have the perception of order flow. They don't look at things that are uh, beyond the scope of support or resistance, diagonal support, diagonal resistance with trend lines, or some kind of pattern. And these classic chart patterns, while we can historically go back and see how they may have worked visually in certain instances, but that's not what causes price to do that. So if we can look for times when the retail trader is arm wrestling, something that's a little bit more, I guess, more real, like orders in the marketplace, why the market should trade to a level, why, like, there's nothing inherently bullish about a pennant pattern or a bull flag pattern. Just because you see it rally up a little bit and it starts to consolidate, retail traders would see that as, oh, it's a bull flag, so it's getting ready to go higher. But if the market's not predisposed to want to go higher because there's a resting pool of liquidity up there and it's already done the damage below that bull flag, meaning that it's made the market jagged. If it's smooth above that bull flag in price action somewhere in close proximity, chances are that bull flag would probably deliver on the basis of what a retail trader would expect, because then they're finding themselves trading a pattern within the underlying order flow that price is going to submit to, because it's running for the liquidity. It's not running because it sees a bull flag. It's not going to go up because there's a bull flag there. And vice versa, if there's something that's indicating that the market's likely to go lower, just because there might be a bear flag or a pennant pattern or a wedge pattern or a descending triangle, these are all classic perceived price patterns. And because that idea is prevalent in trading, and Dad started the same way, reading these books, you think, wow, it demystifies all of these open, high, low, and close bars, which is what I was using when I first started. Um, it gives you a rhyme or reason as to why you should do the very thing that I'm teaching my students to do, the slowest movement towards, which is executing and pushing the button. And retail is given lots of excuses to go in there and take trades. Just take trades because look at all these things. These are reasons to get into a trade. Versus, let's take a step back and think to ourselves, what would be the underlying catalyst for that price pattern to see it unfold like that? Just because you think you see it like a Rorschach pattern. If you go to see a psychologist, they'll take a piece of paper and they'll drop a drop of ink on it, and then they'll fold the paper in half, move it around a little bit, and then open it up, let it dry, and then it'll be shown to a patient, and they'll say, "What do you see?" And whatever they want to manifest, whatever they're seeking internally, or whatever they're fearful of, they'll see that in that Rorschach. It's an ink blot. It's nothing to it, but it allows the psychologist or the person that's doing an evaluation on them to get a baseline of how they internalize things. And whatever you internalize, you're gonna materialize that in your decision making in trading. So if you are a person that is constantly looking for something that is based on like a gambler, like they're gonna have a list of of things to get them into a trade. They're going to have a lot of things. They're going to be looking for every classic bullish pattern because they think the market's going up because they've been some kind of Reddit channel, or they've been in a Telegram channel, or they watch my video and they probably heard something that they think that I'm trying to give them some little message that, hey, look, it's time to buy, it's time to sell. And they just now they're keyed up. They're ready to be looking for that thing that gets them into something. And I fell victim to that a lot as a 20-year-old. Like I unfortunately weaponized myself with all these poor excuses to get into a trade. And it has to be more to it. And we're inside half the gap. So if we're bearish, son, this is what you want to be looking at. Even though we went through the fair value gap, it's fine. I mentioned earlier, I said, I think we're going to have a lackluster morning when we first started the session. But because we went back into that opening range gap, which is that shaded area, it's pink, we want to see it stay out of that upper portion. So this red level here to this high up here, we don't want to see any of that. It can touch the constant encroachment, that wick, or another wick, it can trade up there, but we don't want any bodies up there. So we want, this is like a no-go zone. All this area right here. We want to see that portion left alone. We don't want to see nothing up there if it's bearish. So how do you use this information? Well, if it starts to displace lower and leaves and gets below this fair value gap, I know these are not good choices of color, but as long as it stays outside of this area up here, it can wick into it. We just don't want to start seeing bodies laying down in this area, because then it makes it even more likely that the market's going to be indecisive. So by having these parameters, it says you're willing to let it trade up here and still hold the idea that it could potentially visit down here for the sell side, because it's TGIF Friday. Thank God it's Friday. That's what it means. And it means simply looking for a 20 to 30% retracement on the weekly range. So the highest high of the week to the lowest low of the week, you drop a fib on that. And what the 20% level is, that's what my objective is to see, do we have a reason to frame something technically to get to that level? And I'll show you what that is in a minute, but I just want to give you the foundations of what we're looking for. So in this gap here, right now, this is the framework that would be expected based on the fact that we didn't trade to the upper half of that opening range gap. So because we haven't even touched the consequent encroachment, if we leave, like we've done here, if we leave that, come back up, you can touch that first fair value gap again, and it can be treated as an inversion. I'm sorry, I did it again. This is why Dad does not have the stuff on the charts when I'm trading, but because I'm describing it as I'm watching it. I made the mistake the other day, and I called a reclaimed bullish fair value gap, inversion fair value gap. And once I started talking about it, because I was live, I just kept going on with it, and I didn't realize until I went back in answering someone else's question. They didn't notice it, but when I saw, I was like, oh no, I did that wrong. So this weekend on your channel, I'm going to make a small little presentation about that. But because we had this down close candle and the market was going back up into it, that is a potential bearish fair value gap. And we went above it here, but if we leave it, see, I don't want to see it do that. While we did have the wick outside of it, the fact that we kept the body inside of it, that's exactly what I'm talking about. This is the very things I was mentioning when we first started the stream, that I have very low expectations, but I have to, because they're all listening and you're learning too. My personal expectation is, and the only thing that I would want to frame on a trade setup this morning would be a run into this area down here. Even if it's bullish, even if it wants to go higher on the day and keep going higher for the next couple of weeks, it doesn't matter. That this is still something that's reasonable to trade down into. And it's actually beneficial for it to go down there if it's going to go up longer term, because it's going down there to pick up more orders that smart money could buy at a really deep discount relative to where we opened up today. Because we opened up here at this price. And as long as we stay in the lower half down here, that's fine. That this narrative is still potentially there. But just because it's still potentially there doesn't mean or inside the fair value gap, the first fair value gap, why aren't you going short? Like you're probably thinking, okay, Dad, you're in the fair value gap. Why aren't you taking the short? Why aren't you selling it there? Because I want to see it displace below it, leave a body close away from it, and that imbalance, I want to see, does it go back up into it and touch it again, like trade up in the bottom of it, and then I would expect it to trade lower. Or if you want to be very, very conservative, you can wait for it to do like it's doing here. It needs to close away from the low of that fair value gap. Let me darken it up because it's, there you go. So I know these chart colors are not making everybody happy right now, but I don't give a shit. I have to be able to talk about it while I'm doing it. So now we have a small little imbalance right there. I would like to see this candlestick not come back up to it yet. Not yet. I want to see it close, leave that open, and then if it starts to drop away from that, that means this could be a breakaway gap. We'll see. That's okay. I don't like that, but now we need to see it displaced from there. Once, if it does it, you turn your attention over to the 15-second chart. And then the very first fair value gap that forms over here, once it trades back up into it, that could be a catalyst for you to get into a move to ride it down into the sell side here. Do you see what I just did? I worked from one time frame, building what my expectation would be based on very specific parameters. It's, what do you wait for, ICT? What are you waiting for? What are you looking for? What is it that you're expecting to see? And how can I find the setups that are going to be a little bit more favorable versus just picking the first fair value gap? Because now everybody thinks they have a secret weapon because I've taught them to find the first fair value gap in their opening range. So while it's great and they can see it in hindsight, they're still probably scared shitless about how to get into it. And then you have the goobers that will say, well, look, it runs through it. Yeah, it's going to do that. But you have to wait for time. And we're inside the macro now at 9:57. Here, we're inside the time element of it. And you're blending first time. So the market should start spooling. That means it's going to run. It's not directional. It just means it's going to run higher or lower. So how do you determine the direction? Well, we opened up high at the 9:30 price here relative to yesterday's 414. So when the public sees that, they say, wow, we're higher than when we closed yesterday. It's bullish. Let me buy it and chase it. Professionals, they want to see it do what? Settle into that gap. And then the real picture will happen. It'll give you more insights about what the market will likely do. So by having an expectation on what the retail perspective trader will think, if we know that these relative equal lows down here are too obvious, there's resting orders down there. I don't need a depth of market. I don't need a ladder. I don't need a book map. I don't need any kind of these gimmicks that people are leaning on right now. And it's good that they have something to go by, but you don't need that. You know what I'm saying? Like you don't need to have those tools because all you have to do is let the chart tell you. The price is going to tell you everything you need to know. As long as you can see what time it is, what day it is, where do we have an inefficiency? Where's their relative equal highs, relative equal lows? And all you need is just that. And you have everything you need to find setups that are going to never run out of supply. Like you always find setups. So because it's likely to draw down here, and it's Friday, we've moved up every day, bullish. There's your gap right here on the 15-second chart. So all you're doing is you're waiting for opportunities to see price behave in a manner that is obvious. It gives you immediate feedback. If the trade idea is right, you'll see all the things that would lead up to that setup come to fruition quickly. It won't spend a whole lot of time messing around at levels. Like if you expect it to go lower, everything that you would expect to see price use to keep it from going higher, if those factors are not being seen in price action, chances are you have initial feedback that your trade idea is probably not on side. On side means you're right about the directional bias. Or if you're in a trade that you're bullish, that means everything is indicating that the market's still going higher. And there's nothing that should upset you or make you nervous. By having PD arrays and by having things around time, expecting price to behave a certain way, the more things you can stack in your favor, not just simply because it's at 950 to 1010, it's time to take a trade and let's just go in and do something. You have to have a basis of what it is you're framing the idea on. And if you don't have that, then you don't have a narrative understood. And if you're trading without understanding the narrative is not bias. Okay, bias is, are you bullish or are you bearish? You got to go one step beyond that. Like you got to know, where is it likely to go and why would it be realistic to assume it's going to go there? So my framework around the idea of getting down to these lows, make this line here, if that is something that was happening on a Monday, it would probably be less likely to occur because Monday's a new week and they may be doing something entirely different to frame a narrative. Whereas it's Friday today, we've been going up every single day, and we haven't had a lot of range to the upside, but we've traveled higher all this week. So it's reasonable to see some kind of a retracement, and all you do is simply look for reasons to take out old lows or trade or reprice to old lows or an old low. In this case, we have just obvious relative equal lows. So I'm not interested in being long. I don't care less if this thing went up 100 handles. That's just simply not a trade I would be in. Do you understand?
Yes.
So it allows me to be comfortable with one side of the marketplace, waiting for a setup that is logical, that it is in a time that the market's going to behave a certain way where it's easy to see it, where it's easy, it's one-handed, well, not one-handed, one-sided. Think about where we have opened at 9:30 and where we're trading at right now. Other days, when the market has more time in the week before Friday's close, it'll offer a lot better, cleaner price action, and you won't have all of this back and forth, back and forth, back and forth. The reason why we didn't have that large of a gap was indicating that it was going to be this kind of morning. If you're looking to trade and use large leverage, which is most of what my students are trying to do because they're using these funded accounts, they're trying to really strap on this big ass contract size because they want to be able to get something quick. They want to get big windfall victories, and they're greedy and they're impatient. You can't do those types of trades in mornings like this. If you have a large gap, very large gap opening, you have the first signature that tells you, okay, yes. If you know what you're doing and you know what you're expecting, then you can see a little bit larger risk. Not that larger risk is right, but why would you want to risk the maximum in a market that has several things going against it right away? That's a gambler's mentality where they'll go in and they'll try to force their will on it. And Dad has done that a lot when I was 20. Like I'm gonna it stopped me out, or it scared me out of my trade, and I got out of it, and then it ran where I wanted it to go. As a 20-year-old, it would make me mad, and then I'd go in, I'm gonna exact revenge on it. Soybean market, your ass is mine, you know. And then they would hand me my backside even more, you know. And I didn't learn my lesson for a long time doing that. So one of the biggest things I started to invest my time in is determining when not to take trades, when not to expect it to be an invitation for me to get in, but there's always an invitation for you to study. So, perfect example, we opened up with a indication by me at the opening of the session that I think this is going to be a lackluster morning based on how we opened. Because we opened this way, all the things can be in the chart. We have the fair value gap. Did you see me say entry? Did you see me post the demo? Did you see me doing it? No. We're waiting because I want to show you how having this first indication that it's going to be problematic. If you read my comments, okay, most of them are all like sickeningly sweet, like supportive. I love you and I thank you for teaching all that stuff. And that's great. I appreciate all that. But we went to the top of the opening range gap here. Went to the upper quadrant. You see that? and this type of action here, that's actually productive. I like to see that. If we get down below that fair value gap again here, same scenario, then we would want to see it. Now we've had the market redeliver almost to the top, but left a small little portion. See that?
Yes.
So let's play devil's advocate for a minute. Let me finish my thought first. They'll say you're hiding your losing trades. What they don't realize is I'm using what I'm teaching here today, is I'm being highly selective. And they're ignoring the fact that the things I'm talking about live in the live stream, they're the things that are panning out. So now watch your gap here on the 15-second chart. Okay. If it can offer some kind of a smaller fair value gap in the range here before this low is taken, then if it starts to sell off, it should accelerate and very quickly run down into here. But if you don't have if you don't have a skill set or an attempt to get into the marketplace with the pursuit of knowing when you should sit still, why should you rush in to do something right now? Well, you're greedy, you're impatient, you're impulsive, or you're chasing somebody else's influence. And that's one of the things I can't stand about social media, because there's a lot of people online that are selling courses. They're inspiring people watching them to get into a trade. And it's advantageous for them to do that because they're going to blow their account and then they're going to use that same affiliate link underneath that video. And that person's like a drug dealer, getting them hopped up. They're blowing their accounts on their live stream too. And they get used to thinking, oh, it's still cool. We're all a community of losers. And the guy that's running, or the gal that's running the YouTube channel, they're actually profiting off of these zombies that are literally in there, just blindlessly following them and saying, okay, I'm just going to go in here. But we're part of a tribe. We're part of a community. So I'm thankful I didn't come up in that, because I think as a 20-year-old, I probably would have got caught up in it initially because I wanted to find my place in it. And I teach my students that they are home in themselves. They don't need to be in another community. They don't need to be in my community. Okay, there's no team ICT. But imagine if you don't have these reference points like I'm showing you here today, and then also not expecting that it's going to be a problematic morning session. And you just simply go in there and say, well, we have these things. And then we went back to the first 1 minute fair value gap here. So the first presented fair value gap on the 1 minute chart is this dark one here. I'm going to take this shaded area off. This is your 1 minute first presented fair value gap. And it's valid because it is at 9:35. It's not on 9:30 candle. So anything between 9:31 or 9:31 to 10 o'clock, whatever fair value gap that forms on the 1 minute chart, that's yours. That's the one you use. I don't care what anybody else does with it. If they're welcome to experiment and do whatever they want with it. But that's the one you use. In time, you will start to use this information here, and then you can use a 15-second or a 45-second or a 30-second. But you have to start somewhere. And your starting point is this one. This way, it tells Dad, by watching what you do, and when you do your executions, I will see how you use that first presented fair value gap. And it'll help you determine where you're messing up. Because if you don't start at the same reference point to get your bearings, like this is a common price level that everybody that's watching can still do the same thing that you're doing. Learn how to reprice based on that one reference point. Basically, all this is telling you is the market's bullish when it's above it, and it's bearish when it's below it. But we have to allow that volatility that occurs in the first 30 minutes to traverse above and below it. And then when we get to a macro time, like 9:50 to 10:10, if everything is in play and they've already made the upper portion of it jagged, did they not take out this high with this run here?
Yes.
So if it's bearish, it would have already went down here if it would have been a larger gap opening. It would have already done it. It would have been done and dusted, and we probably would have ended the stream button. But because it had all the indications, but it was not a very, very large gap, and how we behaved right at 9:30 and what we've been doing has led to exactly what I said at the beginning of the stream, where it's going to be a lackluster morning session. Now, that doesn't mean that hasn't had setups. I mean, we were trading yesterday, watching them go up and down, and I did it with my private students last night too, teaching them how to practice and do drills. And we ran up $34,000 in just a little bit of time yesterday. Here, you're being met with a little bit more challenging environment. So you have to be highly selective about what you're trying to take a trade on. What would be wrong? What would be inherently wrong about taking a trade if the market went below here? Over here on the 1 minute chart, let's say that you waited for a price to go below that, and you went short down there. Is that technically, in your opinion, is that something that would be viable? Would it be high risk? Would it be low risk? If you waited for it to go down below this low, knowing based on what you have an understanding, and don't be afraid to answer it. Just tell me what you think. Would it be advantageous for you to be short after it goes below this low to get to this level down here?
I wouldn't say it's advantageous. My opinion would be somewhat leaning towards chasing price, in my opinion.
Normally, yeah. Yes. But because we have the smooth area in price action over here, contrast this, all these, well, not all these two relative equal lows, contrast that with, that's what's below the market price. So below the market price, things are smooth. We have smooth lows here. The market has traded higher, taking out this short-term high, and we went into the upper half of that opening range gap. He's clearing his throat. He's coming off of a bug. You good? Cough up a lung? Come on, man, this is basic training. You ain't got time for this pussy shit. So we have the market take out this high here, and it took out this high here. So it had aggression going up in the upper half of that opening range gap. Was it able to stay there?
No.
They can't hear you shake your head no.
Sorry.
Did it stay there?
No.
Okay. Where did the body stop? At this line right here, right? What is this line? It's the upper quadrant of the gap between 9:30's opening price and yesterday's 4:14 final settlement price. So when it went up here, the bodies are telling you, yes, we went up into the upper half, because ICT's on a live stream saying it's better if you don't do it, so they want to mess around with it, but it's still okay, because the bodies are telling you that it is not laying a body to the upper half entirely. It's just going to the upper quadrant level. It wicks, but it left a small little portion open up here. So because it's done these types of things here, I still favor the market wilting and rolling over and going down to attack and reprice into those sell side. The problem is, and this is what my students encounter, and this is why I tell them when we first did paid mentorship in September of 2016, when I was teaching these kind of concepts, I had assholes in there that were expecting me to spoon feed them trade setups. Here's a stop, here's an entry, here's your target. And they signed an agreement digitally knowing that that's not what this was. I'm teaching how to reprice action. And the first lessons I was teaching them was to learn these types of setups where if you know it's going to be hard for you to climb a hill because it's just snowed and it's icy, why would you want to risk your brand new car trying to drive up this icy hill when you could just go out of route, wait a little bit, go down a different pathway to avoid that hill? You can get to the same destination, but don't do that thing there. But everybody's going to say, well, the shortest path to get to the 7-Eleven, because I got to get my cigarettes, I got to get my morning coffee because I got to go to work. They're going to do what everybody else is going to try to do. And then watch it on YouTube. You see these people. They see other cars have failed. Oh, not me. I know how to do it. Yeah, you did it better. You smashed into 4 cars now. So having an understanding of how you're going to get kicked out of this game prematurely or hurt yourself or force yourself trying to do something that is not likely to be successful at that time, at that moment. Not that what you're trying to do is flawed logic. It just means that you're trying to put something together that is most likely not going to pan out at that moment in time. So there's going to you're going to see things that's going to be adversarial to that. So knowing these things and how to read it will help, in my opinion. It would have helped me, I know that. Try to keep you from taking trades that you might think are there. They might look like they're really there. And then when you get in them, they run against you. And then you get frustrated. And if you're not in control of yourself and you can't compose yourself and maintain that composure while you're watching price, you'll go on what's called tilt, or you just basically go into gambler's numbness. And you just start clicking the button because you just want to escape that pain of what you just did was wrong. And you can't reconcile it. So the only thing you can do is do what? Get more of the hair of the dog that bit you. And you go in there and you just do something else impulsively, hoping that you're going to get a lottery win, because that'll distract you from the pain and discomfort of you knowing that you impulsively did something. Knowing that what I'm teaching is giving you the framework to just justify why you should sit still. Just sit still. Paper trade it. Demo trade it. Tape read it, where you don't push any buttons. That's what you're supposed to be doing. When you see a market environment, it's going to be problematic. No problem. It's much more helpful, and progress is better acquired by looking at price like this and saying, okay, there's no entry, there's no loss. I didn't miss any profit, and I'm not feeling the pain or the regret, buyer's or seller's remorse. You're not having that experience right now. Other traders out there that have been trying to trade today, if they're wrong, I'm not saying all of them are wrong. I'm sure somebody's out there made something. But it's in a market that's a little bit more problematic. It's not impossible. It's not that you can't find a setup in it. This means that having these technicals like this today, chances of you as a brand new student being able to navigate this and have money behind the idea of being right or wrong at the end of that transaction, it's going to be much more stressful. And I try to teach my students, watch this wick here. I try to teach my students how they can go in and watch price action while they're in a trade. I'll take these quadrants off. I like to watch and how price behaves around its midpoint of its wicks. I'd like to see it wilt right through that and then rush down into that sell side. So it's not enough just to say, I have a model. I can see the relative equal lows. I can see the relative equal highs. You have to know the lay of the land, the terrain, and if you anticipate the market's going to be very, very fluid, meaning that Dad teaches there's two types of trading conditions in the marketplace. There's high resistance liquidity runs, which is what we're seeing here. The market's having difficulties trying to run to the obvious liquidity. It's down there. We can clearly see their sell side down there. But it's encountering what? High resistance, not in the sense of resistance and support like a retail trader. It's resisting the easy, fast, straight shot right to the liquidity.
What would cause that?
Well, the conditions of opening up the way we did, it was not a rather large gap. A large opening gap, that's like the precursor to we're going to have a really fluid market. A really large gap, and I like 75 handles. That's personal, like that's my thing. I can trade in all this mess here too, but I've learned by doing these days like this, and I'm trading them, and I'll show a recording of me doing it. When it's like this, and students are aware, they can see it. It's being a little bit apprehensive about going to where it would obviously make perfect sense for it to go down to that sell side. It would, because it's clear, it's easy, it's relative equal lows, it's smooth, and we've made it jagged on the upside. All of this up here is jagged, and what's smooth is what remains over here. So it's hard for them to keep submitting to that idea every time it creates these jumps back up, or it consolidates and it drops and it comes right back. That's what scares them. And they're all characteristics that are hallmarks for high resistance liquidity runs. And I tried to teach my students that when I was teaching Forex, that as soon as you can pick up on those characteristics in price action, when they're not in the marketplace, you have low resistance liquidity run markets where the markets are easy. They just go in right from your entry and they just go right to the liquidity or right to the inefficiency. And it's fast delivery, immediate feedback. As soon as you recognize you're in a high resistance liquidity run type market like this, you should dial back your leverage. You should slow down if you get stopped out. Really take a second chance of do I really want to get back in the trade? Or let me just take this trade on paper, or let me just tape read it and just get the experience that way. Because I've already took a loss, so that way, if I compound that loss, it won't be worse. And it's even more demoralizing when it's a Friday, because if you lose on Friday, or if you lost your weekly profits, that you've accrued all throughout the week, and here you're on Friday and you go on tilt, you go into gambler's numbness and you just wipe it all out and more, that makes a very painful weekend. And I had lots of them as a young man.
Mm-hmm.
I hated it. And I couldn't wait to get back to Monday so I can go and gamble some more.
I was going to say it would make you make even worse decisions come Monday.
Exactly. And it was just like this cycle that would repeat over and over and over again. So one of the things that the dickheads that like to troll me with, they take and they cherry pick certain things, and they'll say, well, this is why this stuff doesn't work. Or this is why this sucks. This is why ICT can't trade. ICT knows how to fucking trade. Okay. I know how to fucking trade. They don't know how to see these things. And I'm trying to communicate to not only them so they can pull their head out of their ass, but everyone else that's willing to listen. And you, because you're my son, you're perfect example. Look what it is. It got real close to it, and then now you see this. That's exactly what a high resistance liquidity run market does. It's frustrating. It's like, you ever see that old commercial for Geico? It has this old guy and he's in these fishing chaps, and he's got the little dollar bill hanging from the fishing rod, and he's like dangling the dolly, and then he try to reach for it. He's, oh, you got to be quicker than that. Oh, you almost had it. And that's kind of like what a high resistance liquidity run market is like. It teases you a lot. And then when you finally lose money and you get fed up with it, that's when you turn the charts off. You go away and you come back 30 minutes later or an hour later, and it ran right to where you thought it was going to go. And you're like, you son of a bitch. So what do you want to do now? You want to go in the afternoon and rush to get something back. Or you go through the weekend and you abuse your family members, abuse your dog, go out to the bar, get inebriated, spend your girl money on somebody that ain't going to go home with you. And then you just compound that loser cycle. And then what do? You carry that over into next week, and you're starting on the wrong foot immediately, doing all the wrong things because you have this toxic mindset. Now, contrast that with here's our signatures that we're noticing today. We had a rather, it's not a large opening range gap, but it did gap. It's not giving me the delivery of price that would be synonymous with a low resistance liquidity run market, where it's going to move quickly to it. It's going to be a lot of give and take back and forth. And eventually, after it's grinded down everybody else, because that's really what's going on. That's what it's doing. These conditions, this is manually intervened. That means there's something external that's not script, it's not AI driven. These are all manually intervened conditions. The only time that it is AI driven, artificially driven, in other words, it's algorithmic, is when it's time distortion. This is not time distortion. This is highly, absolutely 100% manually intervened. So that means they're saying, no, not yet, no, not yet, no, not yet. So as soon as you recognize those, well, that's what I call a signature. When you can recognize that's what this is, or you can recognize it going into the opening in the morning, just simply avoid it. Just sit still, and you're going to find that it is so much more it's better knowing when to sit outside of these types of days. Even though you can read it and you can see it, it's more fulfilling to me as someone that's been doing this for more than 30 years now. I take more pleasure out of knowing that they are not beating me in this. Whereas a younger man, it was constantly beating me up. The bond market would slap me around. The currency futures would slap me around. And I had to either I had to learn this skill set or I was never going to make it. I was never going to learn how to do it. I wasn't going to be able to maintain an interest because it was constantly hemorrhaging money. So most of what Dad was losing on were environments like this, and or I was going long, and it was a market that was bearish, and I just didn't understand how to sell short. So I was extremely limited. So I had absolutely no business being in there trying to trade with real money. But everybody does stupid shit, right? So when I teach my students, and I had a lot of people quit the mentorship in the first 3 months in 2016, and they're fucking idiots. Like they're idiots because I was teaching them how to avoid losing. Like that's the number one skill set. Like as a kid, everybody's played this game before, and you used to ask me as a little boy too, Dad, if you could pick one superpower, what would it be? Could you fly? You can turn invisible. Nightcrawler. You can teleport. You can do all this stuff, and it's interesting to see. And for the folks that are listening, if you want to actually be a part of it for an interactive study for me, and I'll share it with my son too. If you had a superpower that you could pick, what superpower would you pick? You can only have one. What superpower would it be? Well, as a trader, I would want the skill set where I don't take losing trades. It's fucking pretty obvious, right?
Yeah.
It's obvious.
Yeah.
So obviously we can't say that there's a superpower that can be given to us. Like we can't mutate and have a track record that never has losing trades. So we're forced to do what? We have to develop a skill. We have to develop some kind of repertoire, have an arsenal at our disposal where we can at least do the maximum in terms of preventing that, or at least not falling victim to conditions that would lay a perfect table for you to sit down to, thinking you're going to eat fine dining, and you get McDonald's menu bullshit. They ain't even food, and you get sick, and it hurts your equity, and it hurts your mindset. And if you do things that are, I mean, look at what it's doing right here. This is exactly what I'm talking about. Like there are people out there. I guarantee you. I'll go back and watch their streams later on. They'll be in here and they'll be talking about what they think is going to happen, or they'll be complaining about, oh, why is the market doing this to me? Well, that's what these lessons are for. So that way you don't have to feel that way. I don't feel any regret. I don't feel any, I'm indifferent because I knew coming into today, this was going to be a lackluster morning. Mm-hmm. So how do you use this information? You don't trade with real money on those days, but you should tape read it. Or do a demo with one contract with a micro, not many. So that way you're not worried about the money. It won't hurt your ego if you do it wrong. And you test every single time that the market would be a entry for you to try to get down to where you would expect it to trade to, and then count how many times it fails. And when it finally does, if you get it, how many things you had to go through to get that one winning trade. Is it worth it? When you draw down on 5 or 6 trades and you finally get that, oh, it went to my target, but look at what your commission costs are going to be on that day. Look at what your drawdown is. Even though it went to that target, your net loss, you're negative on the day. So you're spending money on commissions.
But I was right.
It's a number one contributing factor to overtraders. They can still climb out of the dollar drawdown if they're good, if they're lucky, if it works out in their favor. But what most people do on the internet, when they see people do this, they've done it in live streams, they've done it in hindsight or whatever, they think, wow, they got out of that drawdown, not realizing that the guy probably had $2,500 in commission costs because he did 100 trades, So,
but I was right.
Yeah, but they want to project the image not only to themselves, to the world. I was right, or I'm a better trader than you think I am. But let's look at the math behind it. Let's see what the real commission costs and NFA fees, all those things add up. And the average trader out there that's learning how to do this, they don't know that stuff. So they fall victim to these assholes that are scamming them. And they don't have a skill set to protect their student, or at least to put them in the right direction to how best avoid problem markets. Look at it. Look how close it got down there. But now look where it's at here. Isn't that frustrating if you were trying to be short? Mm-hmm. There's no doubt about it. Anybody that would have been short would be stopped out.
Oh, yeah.
And they're thinking, shit, what am I going to do? Now go back to the 1 minute chart. And I'm telling you, these are lessons that if I was 20 years old and someone was sitting down with me, it would have gave me framework. It would have slowed my roll because I was rushing to get out of 9 to 5. I was doing everything I possibly could to get myself into trades because I was thinking if I get into trades, I'll be able to make more money. The faster I can make money, the faster I can stop going to these stupid ass jobs and work 13 hours a day. Like I hated it. I hated it. And I was willing to put myself through pain thinking that it was worth it. It was not worth it.
I was gonna say, was it?
No, it caused that all kinds of problems and digestive issues, um, mental disorders because of placing so much emphasis on I have to do it right now. And now looking back as a 50-year-old man, I didn't have to. Clearly, I didn't get it as soon as I wanted it to happen, right? So what did I have to submit to? Time. And if I did the things correctly, like I taught my students and actively still teaching, is to simply just relax and stop trying to make that next trade your entire career. It's not a make it or break it, be all end all result at the end of that next trade. But as a 20-year-old, every single time I took a trade, it was like that. It wasn't just, if I lose on this one, it's okay. It doesn't hurt me. It doesn't hurt me mentally. It doesn't hurt me financially. But every single trade I framed did both of those things. It hurt me financially and it hurt me mentally because I was stressing while I was in the trade. There was never a time when I was 20 years old, I was in a trade where I was calm. I was never like that. I was absolutely at my wits' end every single moment I was in the trade. And many times I was stressed leading up to the trade, like almost wanting to vomit. So, and I'm sure some of you out there listening, you probably feel very similar things, especially if you've ever experienced losing or if you lost some money. And it's like the surest way to avoid that is give yourself permission to simply not know what to do at that given time. And for you live streamers out there, like I'm one of the biggest personality in trading right now. It won't stay that way. I'm just hot right now. And when I stop putting out content and stop live streaming, I'll fizzle out and somebody else will come up. And that's how it should be. But if you're live streaming, don't be afraid or embarrassed to say, you know what? I don't know what to do right now. And I, with 32 years experience, would have a great deal of respect for something like that. But you don't see that so much. You see emotional outbursts, meltdowns. Oh, why is it doing this to me? Oh, I can't understand this. If I wasn't watching the chart, it would do this. Stop talking like that. Because the only thing you're doing is anchoring all that stuff emotionally and psychologically to yourself. You're chaining all that negativity to yourself when you do that. And not only are you doing it to yourself, but your viewers are watching that. And if you're trying to be a mentor or if you're trying to be a influencer, you know what you're doing? You're influencing toxicity. You're literally festering negativity, and it's something that can be collected by your audience versus empowering them by watching you be responsible with yourself and say, you know what? Yes, I have thousands of people watching me. Yes, they all have expectations of me being able to be right about something or making money or passing a combine or making some kind of money that could eventually, after a certain number of days, allow me and afford me a withdrawal. Okay, that's wonderful. But as someone that trades, I'm more interested in how people think and how they conduct themselves. And if they're not going to be willing to admit when they don't know something and they are allowing their personality and ego, and I have probably the largest ego on the internet because it's part of who I am as a character. I have to present that. I want you to hate me first and then come in and try to prove me wrong. That's my whole spit. That's what I've always done. I play a heel, but really I'm a baby face in the industry. Like I want everybody to do well. I don't hate everyone or hate anyone. They do certain things that get on my nerves. They go too far with personal shit. But otherwise, I mean, I don't have a vendetta against anybody. So you as a trader, you as an influencer, you as a student, you have to afford yourself the permission. You have to grant yourself permission that there's going to be times where you know what, it might do this, but I'm just not technically going to take a trade. I'm not going to do it. I'm going to sit still because it just doesn't feel right. And I'd rather err on the side of caution than go out there and just roll the dice. And if I'm right, I can't feel good about that. But most of you that are influencers or trying to be an influencer, you'll grab onto that and you'll pony it around in front of everybody. Look what I did. Look what I did. Yeah, bro, look at me. And that's also feeding yourself toxicity because you know down in your heart that you were not comfortable taking that trade. You just did it because you have an audience watching you. When you are trading in the privacy of your own office, your own home, whatever you're trading, there's nobody there to inspire and there's nobody there to impress. And there's certainly no one there to dry your tears when you do shit wrong. So you might as well just start doing things with that perspective in mind and be responsible. Start on the responsible foot first. That means, how do I present myself a way or a manner of going into this where I'm not openly inviting ruin? How can I avoid all that stuff? And by expecting the market to behave a certain way, waiting for it to be better in terms of technicals. Just because you see it delivering where we said it was going to go today doesn't mean that that's a day that you should be, as a new student, that you should be trading it. It takes a lot more experience, and that's something that you get by watching the charts, spending time with me over live charts, so that we can see, oh, I can see what he's talking about. It is going back and forth in here, but ultimately it goes to where I say it's going to go, but you might not have the ability to be in the trade at that time because you got into it earlier, or you got stopped out and then you're in drawdown and you went in there and tried to do a little bit more leverage because all you have to do now is get half of the move you just lost on to get back to break even. You got to stop thinking about break even. Stop thinking about, I got to make my money back, get the back break even. You didn't start trading to be break even. Nobody gets in this business to say, I want to make nothing but pay commissions. I want to be break even. I want to have the same amount of money I had in my account when I first started. Nobody does that. But something happens when you start doing things impulsively where you lose sight of what you're doing and you fixate all of your concerns, your fears, and your hopes all around just getting back to, if I could just get my account back to where it was before I took this losing trade or before I started this losing streak. If you stop thinking that way and say, okay, I feel that impulse, you have to journal it. Say, right now, I am wrestling with trying to overcome a losing trade or a drawdown. So therefore, I acknowledge that I am feeling these impulses, but I'm reminding myself and encouraging myself that I am not in trading to just simply try to get back to a state of comfort. I am comfortable. I have a model that I trust that I did back testing on. I did not rush into live trading with real money. I am comfortable in my own skin. I am home, right where I'm at trading. So I'm not in any emergency. There's no emergency. I don't owe anybody money. I'm not in debt with the mafia, so I don't have to get this money back real quick and put it in their hands. Your life is not in danger because you're in drawdown. You have to encourage yourself, remind yourself that you're in this to make money. And if you're constantly counting what you have and what you don't have, what you have, what you don't have, you're going to drive yourself nuts. And that means you're going to be emotionally trading. You're going to be trading your P&L, your equity curve, or your equity slope. Your equity slope will be the catalyst for why you're trying to take a trade because you want to try to get out of that as soon as you can. And if you're one of those prop trading guys or gals, you're thinking, I don't care if I blow up because it's just cheaper for me to reset. It's nothing. It's just a reset. And that's why you're doing 100 plus resets. That's why you're doing 30 resets in the last 6 weeks because you've already given yourself permission. You've afforded yourself the permission to fail consistently because all it is an easy reset. Thank God the reset button's there. What? How the hell is that sound logic? How is that something that anybody should say, you know what, that's the mentality I'm going to adopt? But yet it happens to majority of people in trading. Why is that? It's a compensation for the pain and discomfort. You have to have something to distract yourself from what you're feeling and what you're thinking. And I'm trying to teach you, just like I was teaching my paid students, that some of them simply didn't want to hear it. They didn't want to hear it. And they don't realize that there is a way to recognize when the market's going to be reluctant to go where you want it to go. And you have to recognize that. And then you have to wait or do nothing. And there's nothing wrong with doing nothing. It's better and it's much more mature as a trader for you to recognize when you might be a good trader. I would consider myself the best fucking trader on this planet, and I got no shame in saying that. That's not me being egotistical. That's just the facts. I am absolutely the fucking best on this planet. This spinning rock, there ain't nobody gonna trade better than me, and I've invited it, and nobody's doing it. I will show you every fucking entry mechanism, and I will run circles around you. But just because of that, I know my limitations. I know what the market's doing. I know when it's likely to hurt me, even with what I know, because it's simply going to say, not yet, or not today, not right now. And I can sit out here and tell you, I'm going to sit still, and I'm completely comfortable in my skin. Little ankle biters, nose miners out there that like to troll, they'll say, oh, he doesn't know what he's doing. But I guarantee you, if you showed your P&L today, if you even have money or an account at all, you've lost money today. And you probably were stressed out, freaking out. Or you did something that wasn't even your model. You just want to do something that was contrary. So you can go on social media and say, look at this. I'm not here to do that. If you want to measure your dick, I'm out here. I'll lay mine on the fucking table. It's no problem. But none of them guys are doing it. But they'll come back and they'll give you all this stuff to discourage you or make you second guess it. I'm here telling you how to engage this, how to see it for what it really is. And when it's clean price action, when it's going to be real fluid, it's real easy. It's easy to see the setups and they just run. That's what you'll see and spot those conditions easier, and you'll be able to recognize them by studying when the market's like this. Knowing when you're going to be walking in a quagmire, like a swamp. The fastest guy in the world can't run his speed in ankle deep water or mud. It just ain't going to happen. Anybody else would be running basically the same speed because they're all playing in the same field. Well, we're all trading the same market right now. Everybody's seeing the same high and low. Everyone's seeing the same fluctuation in price action. But not everybody has the same expectation. Not everybody is out here trying to run a marathon in it. I'm not. And I have a great deal of affinity for the people that are online that do stream that are honest and they say, you know what? I just don't feel like I should do anything right now. I'm going to stay with the stream. I'll give some commentary, but I don't trust myself in this environment. You know what that is? That's maturity. That's someone that has done the work. They've done themselves in the past. They've learned from that experience, and now they're being responsible as a trader. They're being responsible with their audience. They're being responsible with their own actions. Versus, contrast that with the opposite. Well, we're doing a show here. We're here to entertain you, and you know what? If something happens, we all can just go and pay for another reset. It's time to take some inventory. Who's influencing you? How are they influencing you? Are you better for the influence they have instilled into you? Or the influence they have a hold over you with? Are you more improved as a trader by allowing these individuals to influence you? Or are they actually holding you back? Are they encouraging bad habits that you can't recognize? These are the same people that are going to tell you they don't journal. Because journal takes effort. Journaling takes accountability into question. And you have to be accountable. If you're not going to be accountable to yourself, who's going to be accountable for you? Your balance is. That's the one that you'll never be able to argue with that. The balance in your equity, the amount of money that you've made or lost and what you have right now, what's left, that's who you're accountable to. But you put blinders onto it. Oh, well, you know, I can just reset. I'll just put more money in it. How long do you want to keep doing that before you start getting better? You have to recognize when these odds are stacked against you. Everything in the market is there for us to see. But sometimes these opportunities are cleverly disguised impossibilities. That means that you can see it. It's like that carrot dangling in front of you. That horse or that donkey, it'll keep running towards that carrot, not realizing because it's stupid that it's never going to get it. but they keep chasing after it. You're doing the same thing with your trading because you don't recognize what you're doing. You're stuck on the treadmill. You're not gaining any ground. You're just spinning the wheels. And the only people that's making money are these funded account firms that are getting resets, and the people that run their affiliate links. They're getting paid back in commission, and or the brokers getting commission costs fees, and you're making nothing. So you got to stop thinking about, I got to get back to break even. You didn't start to be a break even trader. There's nothing wrong with being a break even trader, where you make a little bit of money and you lose it. You may go down a little bit and you come back to break even just by the natural progress of you doing what you're doing and while you're learning. But that's not why you started. And you have to recognize how you're going to blow it. You're going to do that initially by how you think and how you behave and what impulses that you submit yourself to. And that's what journaling helps you recognize. And you have to be honest and be sweet to yourself with positive self-talk. That means you're counseling yourself. Treat yourself as that inner child that you're trying to nurture, not beat up or abuse. And the other half is how you're going to fall victim in the marketplace. So when there's going to be a day where it's going to probably be a little bit more reluctant to behave like you would like it to do, you have a choice. You can sit in front of it, tape read it for experience, and then be thankful that you didn't put real money or executions behind it that causes you harm. Or turn the charts off and come back after the market closes and be rewarded that you had the discipline, the maturity, the foresight to know that I know that there was people out there that did something in this market today and they got hurt and they're frustrated because they want the market to run higher or they want the market to run lower. And it's been back and forth retracements, and it's not really moving a whole lot. There's setups here. There absolutely are setups here. But I'm trying to remind you as a beginning student or a novice that's maybe you've been around me for a year or so, you're still not equipped to trade in environments like this. And if you made money, you might think to yourself, well, you're not me, I see, because look at this trade. And you maybe probably already sent me a tweet saying what you did. I don't congratulate anybody in that because I'm trying to remind you all as a collection of my students that it's nothing wrong about you having seen this day initially as an opportunity and then fell victim to it. That's actually good. Now you have something to measure your future expectations against. Now you have I touched the burning hot pot. I got burned. I don't need to do that 17 times to realize doing that is going to cause me harm. So the takeaway is this. We can see that the gap higher in the opening at 9:30 was higher than the price at 4:14 yesterday. That means the initial bias during the opening range is bearish. We know that 70% of the time, half of that opening range gap gets filled or traded to in that first 30 minutes between 9:30 and 10 o'clock in the morning Eastern time. On a Friday, we know that there's a likelihood that the market will want to retrace 20 to 30% of the weekly range. I said I was going to show you that. So all right, so we have a weekly candlestick. You see that sign up here, upper left-hand corner.
Yes.
That means every,
Yes.
You lose your voice on.
Yeah, clear my throat.
Let's take all the annotations off real quick. Okay, so this is the weekly range for this individual week we're in right now. If we take the low, draw it all up to the highest high, go into your fib settings. You don't need the half. So what you're going to do is you're going to take the 0.25 that I have here. Whenever I'm doing the TGIF measurement, I just take the 5 off and then toggle the 0.3. So what that's going to show me is 20% and 30% respectively on the range. And here's 20% retracement from the highest high of the week, and here's 30% of the range. So having this on the chart now, we can go into let's do a 15-minute time frame. So we opened up here And the 20,421 level, that's this one right here. We opened here on a Friday. We had a gap higher opening. So right away, you already know that the initial bias is for the first 30 minutes, it's going to go down to half of the gap. So half of that gap over here that's not correct. Let me do this. 1 minute chart. Regular trading hours. There we are. And now in this fib, we're just going to highlight the midpoint, the 50 level, and then take these off because we're not measuring the weekly range that we have over here. So we have the higher gap opening here at 9:30. So right away, we know in our mind, our expectation is it could, for the first few minutes, flurry a little bit higher, but ultimately is going to draw to that level there. Because as soon as we get that first opening price at 9:30, that's a static price limit, a static price point. It's not moving, it's not dynamic, it's not fluctuating around. We can still make a higher high on the day in the first few minutes of the opening range. But that constant, which is the opening price at 9:30 relative to yesterday's 414, we have that measurement that tells us this is where 70% of the time that price is getting hit in the first 30 minutes. Sometimes it might take a little bit longer than that, but statistically, they're all seeing it now. And I promise you, if you have that mentality and expectation, it's going to serve you well. So if you have, for instance, this here, we can then go into a 1 minute. Oh, we're already in a 1 minute chart. The it's 9:30, 9:31, 32, 33, 34. So 34 has your first fair value gap there on the 1 minute chart. So we create that fair value gap, trade down, back up. You can be short there with the expectation that it's going to go to the mid gap. So you have a 70% built-in advantage that trade there is likely to pan out. Add to it, it's Friday. TGIF, thank God it's Friday. So that means we also have the 20% level. See, watch what I'm taking my cursor, I'm laying it right on top of that blue line. Look at the price on the right-hand side. See it? And it's also showing it on the weekly chart on the left-hand side. See, I'm putting it right there. So it's 421 and 421 on the 1 minute chart. See it?
Yes.
So that's 20% of the weekly range. So TGIF is, if we're bearish, we're expecting 20% to 30% of the weekly range to be drawn down to when it's been a bullish week. When it's been a bearish week, we're expecting the price to retrace higher to 20 to 30% of the weekly range. Okay? You understand?
Yes.
All right. So now because we have an opening gap here, we already naturally have a built-in 70% likelihood that it's going to trade down here. So what can you use this level for? A partial. So if you got short here, there's going to be exercises I put you through where as soon as you get an opening price like this, you're going to sell short. And you're going to use a 30 handle stop loss and see which one gets hit first. These are all things that I did in the marketplace when I was using currency futures. I would use it with the British pound futures contract, the Deutschmark, which doesn't trade anymore, the Japanese yen, and Canadian dollar. Those were my dollars that I would, commodity dollars. I would use that mechanism to build my initial day trading with this idea, because in the currency futures there would be gap openings, and I was using this. This is my criteria when I was trading currency futures. So because it works in universal markets where you can see the difference between where it was yesterday and where it is today, even if it trades 24 hours now, some markets, you still refer back to those same price points that I'm teaching, and you'll see that there's a gap, even though there isn't a technically visible gap like we have regular trading hours and electronic trading hours in the index futures here. There are markets that don't have that, like Forex. It doesn't change it.
go back and use the same reference points, and you'll have a simulation that would be used the same way as if it was a gap there. So these are all things I can talk about where things that aren't technically in the chart, I'm looking at it that way, where everybody else would not even think of it. It's not even in, it's like it's not in their expectation of what would be reasonable to seem like chasing information based on that type of perspective. When there's a market where it doesn't have electronic trading or where they're trading gaps. Well, the question is, well, how's this useful to me, ICT? I trade Forex and we don't have that. You do, because these reference points are referred to by the algorithm. Just because you don't see a gap in your chart or your platform doesn't mean that the algorithm is not referring back to those same price points by time. And when you start doing that, it's like, oh, wow, I didn't see that. Right. That's why all of you are losing money. That's why you're all clueless. But you have built-in advantage of 70% being short right from the opening bell, trading down to 70% likelihood of that mid-cap getting filled. So you have a built-in advantage. For 30 minutes, you have a sweet spot where you have so many things in your favor versus, and contrast that with trading anything outside of this. You don't know. Like, you don't know. You don't have any data that suggests that that fucking bull flag you think is in the chart is going to do anything. It doesn't mean just because you see a price pattern, it's going to do something. That is the absolute asinine thing that I fell victim to for years in the beginning. And there's people coming into this market all the time, and they buy into that bullshit. And they think, oh, well, you know, the books tell me this, ICT, and you're foolish, and that's not in the book, so therefore it can't be real. It's crazy. But you have a 70% chance it is here from the opening bell, but then you have 20% of a weekly range. So this could be your target for first partial. Aim for this, but what happens if it just goes there? Is it likely to stop there? No. How far can it go? Well, you got 30% right there on the weekly range. So TGIF is giving you what? Partial, target. The market comes right back up to 30% of the weekly range. Isn't that interesting? Isn't that interesting how it happened? It's actually happening inside of a fair value gap as well. And then the market rolls over one more time into an inefficiency there and breaks down. So what you're doing is you're trying to frame conditions where you have everything in your favor and it's hard to find something that would be opposing it. Does that make sense?
Yes. There
are going to be times where what you're trying to do is going to be met with opposition, where price is simply just not going to, it's not going to behave. It's not going to bend to your will. It's not going to bend to your model. It's not going to bend to your time being in the chart and wanting to take a trade because this is the time you're off that week, that day, or that time, or you got up out of your normal sleep schedule to trade this because it's not something you normally do. So therefore, you have more expectation or more demand out of the market and out of what you're trying to do than any other time. So you're creating these hostile conditions where you have to perform. The market has to do what you want to do. So you've emotionally charged everything. You've expected the market to bend to your will. You've expected your model to be perfect. You expected yourself to make money. And then you have a market environment like today where it's just saying, not yet. I'll get real close to it, get you excited, get you real wet. Nah, it's a cold shoulder. Mm-hmm. And it's very, very frustrating. It's extremely frustrating if you don't recognize that's what this type of market's going to do. And then by having that understanding, it'll allow you to hold, if you have initial entries early in the day or before the session starts, pre-session, you don't rush your stop loss into that range. You let it stay back a little while. And if you watch some of the executions I shared, a lot of questions come up with, why do some of your trades where you'll move the stop loss down or up in deference to what I was, in the trade for bullish or bearish? And then there's other trades where I'm in there and I leave my stop just covering costs and maybe, a couple $100 or grand. Why am I doing those types of things? And the response is in this video here, based on what the market's doing and what I think it's going to behave like. How is it going to behave? How is it going to deliver price? Is it going to be in low resistance liquidity run conditions where it's just going to be a liquid fluid market where it just runs real easy to my targets? It's not going to hem and haul, spend a lot of time bouncing around before it does it. Or is it going to be high resistance liquidity runs where I may have entered expecting something to happen, and then something changes because it's manual intervene. High resistance liquidity runs most times are manually intervened. That means they're in there tinkering with it. They're trying to screw with the open interest in the market at that given time in that session. The only time that it's not doing it like that is just ahead of like a FOMC, a non-farm payroll, CPI, PPI number, something that's a big red folder event that usually comes in the marketplace like a landslide and just decimates people initially. What will happen is the market just marks time and just bangs around sideways. And it's not a time for you to trade. But when it's trading in a high resistance liquidity condition like we've had this morning, there are trades there, but you're not likely to have the skill set to recognize that they're going to deeply retrace on you. They may consolidate a little bit, move down in your favor, then come back up and run against what any trail stop loss would be used for. And then you're stuck. You don't get that. You don't get the payout, but you get the frustration at the end of the day or at the end of the session where I was right about my trade. ICT. I get these all the time. I was right about my trade, but I got stopped out and I got chewed up. I got beat up. The chop is real. All that kind of stuff. It's simply not knowing what the characteristics are going to be like before the trading starts, and that's experience. That's also ways that we're outlining here today. The larger the gap, the less likely that it's going to happen. Let's put it that way. If I was going to make a bullet point list of what are the signatures that make a high resistance liquidity run signature, a lackluster opening price gap or opening range gap, less than 75 handles. So right away, if it's less than 75 handles of an opening range gap, that already invites the likelihood of a lethargic, slow morning. Doesn't mean it won't trade. It just means, by definition, that's usually a hallmark that starts it right away. And the less that is, if it's under 40, you definitely have a lackluster morning coming. So if it's 75 handles or less, I'm still expecting it could happen. That's why I'm watching that first 30 minutes, because the first 30 minutes is going to give me the information that I need to say, okay, we're in low resistance or high resistance conditions. You want to recognize as soon as you can if we're in low resistance liquidity run, because if we are, your trades are going to be easy. They're going to be fast. They're going to be immediate feedback. You're going to get right to your targets, and your day is going to be just quick. It's going to be a quick, low stress day. But if you start recognizing, because we have an anemic gap opening, if the market is trading in a manner where it's just not trying to go to a liquidity quickly, and it's spending a whole lot of time inside of inefficiencies, inside of gaps. What does that mean? Let's go back into the 1 minute chart. Over here on the left. Actually, no, I have to go back through all this and add the Control Z, baby. I'll get a message from the guys that know how to use TradingView a lot better than me, and they'll be like, ICT, this is how you can do this. I love that. I have no shame in telling you that my students have taught me more about TradingView than I cared to know, really. I mean, but some of them are really cool things. So see how we had a lot of time inside that gap here? This is your gap, okay? So we spent a lot of time chopping around in there. How many times did we hit this? When we hit consequent approachment like this and came right back up into it here, it should have failed at that point and broke lower, but it didn't. See, it did? It did all this type of movement. That right there was telling me, okay, just chill. And I told you, I said, remember I was telling you at the beginning of the session, it's going to be a lackluster morning session. That means slow your roll. That means don't try to press the button. That means expect it to be harder than we want it to be, easy. But now this is indicating that it's telling you, it's not hiding it, but you just never had anyone sit down and explain to you how to see it, how to recognize that this is going to be hard trading conditions versus the days that are just real clean price action. This market just takes off and runs. And until you spend time with me, or you go through your charts and you look for these types of things, you're not going to appreciate the insight that it gives you, because it gives you an unfair advantage against everybody else. Everybody else is out there trying to do the same thing. I want to take a trade. I have made myself sit down in front of these charts, and damn it, I'm going to make a trade. I'm going to find something. I have to have it. I'm a trader after all. It's in the name. I have to trade. That's bullshit. Because what you're saying is you want to gamble, but call it trading. You want to impulsively make decisions that are without logic, but you want to call that informed trading. You want to do something and chase price and call it informed decision making. And I'm telling you, with someone that's 3 decades experience, all that stuff leads to ruin. Given enough opportunity and time doing it that way, you will lose. And you're going to absolutely hate it. You won't enjoy trading. You won't enjoy studying and journaling and building your enterprise. Your business is you incorporated. So isn't it advantageous for you to say, okay, what barriers do I have in front of me? Think about it. Every corporation has these corporate meetings. They have board meetings. They have their employee management. Every time I was in corporate positions, at 9 o'clock, that was the war room. We had to sit down with other department heads, other managers, and we would look at our KPIs, our performance measurements, and if things were slipping in front of our peers, we were told, look, something's going on. Is there another department or something else impacting your ability to meet your KPIs or excel? And we hashed it out. Sometimes it was drama. Sometimes it was everybody's doing right. Great. But you have to have that same board meeting with yourself every single day in your journal. And you have to have the expectation that you're doing that for the embetterment for yourself as the corporation you incorporated. Your business is not gambling. Your business is trading and managing risk. And the first rule in managing risk is recognizing when that risk is going to be elevated. Having an understanding of how to discern when the market's going to be a harder adversary today than another day where you're going to be more equipped to trade your model, and it's going to be quick, easy, sudden delivery to your price or your targets. Looking at this, you can see there's trades there. I'm going to give you a minute while I take a drink. Using the 15-second chart, everything that's outlined here on the chart right now, can you find at least 2 setups? Don't rush through it. Just take your time and look through it. Because when you get home at nighttime, when you're resting off, you want to go through your charts looking at this stuff. Even when it was a harder market, you want to go back through and pick out where the setups were. And then look at what was right before that setup finally panning out. Because that's the keys of understanding how to avoid these types of days and hurting you rather. The uncomfortable silence. Remember, we recognized early on that it's going to be a lackluster day. That means it's going to be high resistance. So that means your draw is down here. That means everything is framed on the basis of it's going to eventually reach for this relative equal low. So knowing that, your model is built around what? That first presented fair value gap. That's this darker rectangle up here. When we first traded down through it, it came back up, it hit the consequent encroachment, and we wanted to see price at that time displace lower and then find something maybe on a 15-second chart in this drop down, in the first retracement into a fair value gap. I'm speaking like this was the 1-minute chart, but we're actually in the 15-second chart now. But the fair value gap that would have formed on this 15-second chart, the first one will be right in here. But look at the prices doing in here. So we hit consequent encroachment, one more time, step up onto it, hit the low over here. Now, that in itself, that is something you want to see in a low resistance liquidity run condition. where it respects the level here and it respects the level here. But because we went this many times into it, here, 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 it's doing what? It's spending too much time in your fair value gap. Inefficiencies or gaps, you want them to go in, stick their toe in the water, and then run away. You just want to have one quick high five moment, and you're out of there. Goodbye. See you. You're not trying to rub shoulders and elbows and schmooze. You're not trying to hang out in there. And if you start seeing price have a lot of interest getting back to that same area, that's not good. Above old highs, it's okay to see that. Below old lows, it's okay to see that because that's accumulation. You don't want to see accumulation inside of inefficiencies. You want to see them enter it or touch it and then repel away from it. The more times it touches, it's like, well, think about like trend lines. Okay, when I first learned about trend lines, is the more times the trend line can be touched, the stronger the trend line. And that's the biggest bullshit there is too, because if you're hoping that it's going to come back and touch it multiple times, chances are it's going to go through it. So the same thing is happening here. Touches the consequent encroachment, wonderful. Ideal world, it should have dropped right there. If it wouldn't have done this wick here and it just did that, then at that time it should have dropped precipitously and immediately should have ran right from here and just gushed right through this low and sped up right before we get to this low here, have some kind of retracement, and then dump down into it. But that's not going to happen on a day where it's going to be high resistance liquidity. It's going to be met with a lot of back and forth, back and forth, back and forth. So what's actually occurring is this. You have the shorts up here at the opening bell. It drops. The first retracement, that's optimal trade entry. They're short there. Sells off. If they don't take partials, they're going to have to weather this retracement, and now we got relatively equal lows here. What is that doing? It's creating sellers below here. Because retail traders are going to see that as what? It's bullish. We have a doji down here. We got these relatively equal lows. This is support. So now they're going to do what? They're going to look for bull flags. Well, as the market rallies up, it starts to consolidate in here. They think, wow, it's going to go higher. If they're long, where are they going to place their stop loss? Right below here. So what is that going to be? It's a sell stop. Well, that's wonderful because anyone that's trying to get short today, they have willing sellers at a low price once it goes high into any retracement it does. We have a retracement here, but it spent a lot of time inside of your gap. It should have dropped here. It should have dropped here. It didn't. And now look, we're marking time inside your fair value gap. That's not something you want to see. It's doing too much at a level that should have already had a high degree of influence over price. This should have never been going on at all. But because it's high resistance liquidity, it's holding price inside of a range. What range is that? It's the high here and the low here. So who's been making money? At this point right here, who's been making money? The shorts. So what are they going to run for? Their stops. Where's their stop going to be? Above these highs. And it runs right up into the upper portion of the opening range gap. Remember earlier it was pink and I shaded into the white area. Do you remember that?
Yes.
So when it ran up into that, I talked about how the body stopped at the the upper quadrant level of it. The wick did the damage, but it left that upper portion open. That tells you that this level down here is going to get hit. All they did was last little run on the stops up here, and they left that small little portion open. That is an algorithmic signature. It's telling you, it's the algorithm tipping its hand saying, I didn't completely close it in, so that's your okay, it's going to happen now. If it would have completely closed it in and traded outside of it, this would have been less likely to be traded to. Is there anything about what I just said that you don't understand?
No.
Fair value gaps, when you're bearish, you want to see the upper half of it stay open. A fair value gap that's bullish, you want to see the lower half of it stay open. In here, what are you seeing? If we're bearish and we're expecting price to trade down to here, and all things being equal, that we thought that from the opening price it's bearish, we have 70% opening range gap to be traded to, and then once we get to the gap closure, we treat that whole entire range of that opening range gap as a inefficiency. and you treat it the same way as a fair value gap. So if it's bearish, ideally you want to see any turning point when it digs back up into it, stop at the lower half. The white area is the upper half of that opening range gap. We stabbed up into it, so that was that last little ditch effort of doing what? Wiping out anyone that's short. Taking in anyone that wants to go long, but they don't have to be a breakout artist here. So longs are trapped long here. Shorts are stopped out because both the long buy breakout artists and the short buy stop protection, they're being engaged with this rally here. So this is your Judas. They can go back and listen to the stream where I talked about how this is good. They left that open and everything's still in play for that to happen here. But the trolls will look at, oh, look at this. It went back and forth. These things, they ran through. That's exactly what's going to happen on these days. So you have to know that this, you have to be a little bit more flexible. But now when it does this, price comes back down, eats right through your fair value gap. It's exactly what you want to see. It leaves the upper portion of opening range gap, trades down through it, and then comes back up and kisses the low of that first fair value gap. That's your short. That's yours. Your stop loss has to be above your first fair value gap. And your stop, in this case, because it's high resistance liquidity, folks, this is the part where you write shit down. On high resistance liquidity run days, your stop has to factor that fair value gap's range. Meaning this, if you're getting short here, because you have a tendency to see deeper retracements that you're more comfortable being in, or less comfortable being in, the range of this fair value gap from your entry, you have to add that to what would be here, that's your stop, 2 times this. So that means you're probably definitely going into a micro. And some of these individuals that are listening don't want to hear that. I don't want to trade with a stop loss that wide. Then don't trade the day at all. But if you're going to trade, you have to afford yourself the luxury of saying, I'm going to use a stop that is at least 2 times this range, or whatever your fair value gap is. So let's do it like this. Normally, using this area here, you might think, well, I'm just going to put my stop loss just a couple ticks above the gap. No. You want to do this. That's your entry. That's your fair value gap width or height of it. Your stop loss has got to be up here because it can retrace and wick through and then still go back down. So you have to refer to that frame of reference, that measurement of time, of price. So if the price comes back up at a later time, you're affording yourself not just static price action. It's going to take a real move to get up there to take you stop out. And that way it gives you the ability to stay with the trade longer, and you won't feel so scared about being stopped out. Versus if you just go in here and it starts to break away using a stop loss at consequent approachment. On a low resistance liquidity run day, that's what I would use. I'd go 1 tick above that. But we're not in that. And as I mentioned at the beginning of the session, it's a lackluster morning session that's coming. Doesn't mean we can't trade it. It just means that it's going to be more difficult. It's going to require you a whole lot more experience. So your short would be entered here. Your stop loss would be where it was just mentioned ago. And then it trades down through the 15-second gap. But what is it doing in here? Is it showing a willingness to want to run away?
It's consolidating.
It's spending too much time in there. So it's going to be a lot of this. It'll finally move in your favor, come right back up into consequent approachment of that 15-second gap, break lower, not take out the low yet, come back up in here, drive below this low. On a low resistance liquidity run day, I teach to take partials every single time because they're not going to have the skill set to recognize the difference between high resistance liquidity run days and low resistance liquidity run days. For clarity, you want to be pushing your edge. You want to be using your maximum leverage, but not over leverage, on low resistance liquidity run days. You do not want to be doing lots of trades, high leverage, in high resistance liquidity run days because it's going to be like trying to run in quicksand. You're going to tire yourself out and you're probably going to lose. But because I tend to take partials all the time, over time, what will happen is they will train themselves that if we're bearish, every time it takes out a low, once it trades down below that low, that's where a partial will be taken. what type of percentage of your position would you think is appropriate on a day that you already know that you're likely to be met with high resistance? If you have, say, 10 contracts on, which is my standard position size. If I have 10 contracts on NASDAQ, and I know I'm in a high resistance liquidity run day, how many contracts would you suppose is a realistic amount to take off when it goes into profit? Remember, your entry is here. And once it goes below this low, how many contracts of those 10 contracts would you think Dad would want to take off? And there's no right or wrong answer. I'm just saying, well, how many would you think?
Probably between 6 to 8.
That's actually a good answer. I'm actually surprised. I'm surprised. If this is not scripted, I was expecting to probably see like 2, and I'd be like, no, I'd want to take more.
No.
8 would be kind of high, but
I want to say 6 to 7.
Yeah, 6 is a good one. Okay. But then that's remaining 4 contracts. I'd have to sit through all of this drawdown, just all the way back to almost to where I entered. And then once it breaks again, go back to the same motion of, okay, now we're aiming right below this low, but we're in close proximity to what? The original relative equal low. That we can't see it here because we're showing regular trading hours. But let me go into electronic trading hours so you can see it. It's these relative equal lows that we framed the morning on. I already know there's going to be people that probably already signed off. They're like, fuck this guy. Okay. But seriously, like those same people, they're going to lose their ass. They're never going to make any money. And they're going to get chopped up in days like this. And they're going to say, oh, the market was just choppy. The market's doing what it's intended to do. And when it's not being ran by an algorithm and there's manual intervention, you're going to see them deliver in a way that isn't perfect. Like the algorithm, the difference is this. On low resistance liquidity run days, you're going to see that the market delivers to the tick. How do you know there's manual intervention? Because that precision is not there. That means somebody's in there with a spoon and stirring the shit up. That's why you're getting these wild little runs outside of the inefficiencies here. All these little spiky moves. Okay, that's not just chop and the imbalance of buying and selling pressure. That's someone saying, I want these stops. I'm taking it all the way back up here to unseat those individuals that are already short, that trailed their stop losses here. Because there may be an entity that wants to be short and they don't have the size on they have intended to have on yet. Sounds like conspiracy. I know there's people that's listening saying this guy's full of shit. I love that. I absolutely love it because they're never understanding what's going on. But I'm out here doing it. Mm-hmm. So they're seeing these stops taken here. Those stops are absolutely being onboarded right there. How do you know that? Because look how much time it sat there. It didn't go one spike wick and then run away. It sat there and afforded the open interest to enter the market and that pairing of orders. Look at your time in sales. For those that have that information right there, look at this area right in here. From the high of that inefficiency all the way to the high here, look how many contracts were traded there. And you're going to see how smart money slipped right on in there. And then it does this. Quickly shoots lower. Anyone that's short here, here, or here, they're going to take and start offloading their short positions by buying back at a low price. What's convenient is that low has traders that went long. And how they protect their position. They have a sell stop below that low. So how much below this market can it drop below that low? Go back to our first frame of reference, which is those relative equal lows, where the sell side liquidity is. Over here. So if it's going to go below this low, it's reasonable to expect it to do what? Wick and run through those relative equal lows. And it does that here. So even if you didn't understand how to find the right liquidity pools, this is why I teach partials. Every time it takes out a low, you take a partial off if you're short. And over time, because you're supposed to be journaling, that way you'll see, oh, wow, I didn't notice that at the time. Because they're going to be trading when I'm not doing live streams eventually here, right? So they have to have their own skill set. They have their own rules or processes and protocols. And because if they're taking shorts and covering partials below a new low, that's being formed, once that happens, you got to train yourself, son, to take something off, even if it's one contract, because number one, it rewards your patience, it rewards your ability to find the setup, but it also reduces your risk. And over time, all these things blend together, and you get a really rich tapestry and perspective of what it is that you're trying to engage in price. And everything that looks like it's a choppy mess, when you're just simply looking at it like this, like look at it here like that versus this. That looks like, what the hell is that? That's a seismic graph. Okay, it looks like an earthquake, right? Like how's anybody supposed to know anything about the future direction of these individual candlesticks based on anything that's being shown here? But then when you contrast that with, now you have a context added to it. You have the first fair value gap. You have the upper quadrant of the opening range gap. The bias is bearish, aiming down here. So that means every single time it runs stops. What kind of stops? Buy stops. That means it's got to run equal highs or a singular high. And if it does that, does the market go lower? If it's doing that, then you are in high resistance liquidity run conditions, and they're only manipulating price higher just to take the shorts out, and they're taking those positions over by selling short to those buy stops. Perfect example was here. That right there. And the market drops down. Then we have the market right here. Does what? Creates a short-term high, leaves it, comes one more time, touches. Now we're back into algorithmic delivery because the manipulation's done. The manipulation's done. So there's 2 times that they came in today and they stirred the pot. That means someone caused artificially, it wasn't completely AI driven like it normally is. Low resistance liquidity run markets are AI driven. That's why they're real fluid, and just liquidity is easy to see. It runs right to it. And it's everything to the tick. And your precision is going to be bang on. But you will lose that precision in high resistance liquidity days or sessions because you're competing with the person that is in control. So is it not advantageous to recognize this in an early setting while you're developing as a student, to recognize when you are outclassed, when you have an actual predator in there, that you don't know what they're going to do? You don't know that. I don't know that. So it's going to be harder for you to navigate in there. So that's why I trade with less risk, or I simply don't trade, because I don't want to be arm wrestling with someone that I know is outsized me, has control over something that I don't have control over, and they can manipulate it where I don't have any advantage and my edge is removed. So when I taught private mentorship, I started teaching this way. And I wanted the students to sit in there, and it's very dry. It's very boring. And if anybody's still here, I applaud you because you're doing the very most positive thing that you can do for your understanding and your learning, because these are things you're not finding in books, and no other educator is going to touch on these topics. They're not going to touch on it because it's completely alien to them, because 99% of everybody else that's an educator, unless they've been trained by me or found my content leaked, or they learned it from somebody else that's trying to teach it but don't know shit about it, they don't believe in an AI or an algorithm controlling price. So they think it's buying and selling pressure. So they're never going to think of this. They're never going to look at it that way. But that's why I ask you all to suspend your disbelief if you don't think there's an algorithm, just for the sake of our conversations. Hold that idea for a point of argument. If there is an algorithm, there are going to be times where, if there is a instance where the AI is overridden, okay, it's not allowed to do what it's supposed to do. There's some kind of intervention that's taking place. When you see price losing its precision and delivering right to the tick on my PD arrays, when I see that, I'm not looking at they're changing the algorithm. I'm not looking at my stuff doesn't work. Like an asshole, a troll, they'll say this stuff doesn't work. Look what it did here. Look what it did. They completely missed the idea, because I never sat down and taught it until today. When you lose the precision elements of my PD arrays, you're seeing the truest indication that there's manual intervention underway. That means something is afoot. That means they're fucking around with the price. So because you don't know what they're trying to do, chances are you probably don't.
And I don't know what they're going to be doing. Does it make sense for me to go in here and try to trade with large leverage on those days when I know they're in there conducting business? Hell no. Ain't no way. Ain't no way I'm going in there trying to do that because I already have lost every advantage I normally have. But you can still study, you can tape read, or you wait for the obvious disruptions. You wait for the disruptions. It spent time in this inefficiency over here. We've already did the damage up here. This was your Judas swing of the day. Even though it doesn't make a higher high than the opening price, this was the Judas. This is the thing that led everybody astray if they want to be bullish. And it also neutralized anyone that was short because the stops here, here, and even on this little high here is completely gone. They've turned all those buy stops that would protect a short position. They turned them into buy market orders, buying at the market. And anyone that would have used a breakout above this high here, they are tripped long. It doesn't matter what the ratio is to how many people bought long as a new long position above this high or how many were using this area here to protect their short position. It doesn't matter to me. I don't need a book map to tell me how many contracts supposedly. I don't need that shit. You don't need that shit. And I know if they know anything about me, they don't like me when I say that stuff because it's bad for sales or it's bad publicity. But I'm teaching you to do this independent of me and of everything else. But if this been ran up here, this was all done by design with a hand. That was not artificially driven. This was not algorithmic. This was 100% manipulation. And then it went back down in, and look how muddy it is inside the inefficiency again, inside that pink box. And then you see it drop down. This is where the algorithm's firing on what it would normally do. Then it drops down, and then right in here, this is where manual intervention came in. Everybody wants to get out here. So anyone that's short now, where's their stop loss? What is this? Smooth highs. Let me roll it up a little bit. You can see it. See this set right there? Lower high than that one. So that means it's a valid what? Relative equal high. So they intervene here. They pump it all the way up. They consolidate it in here and then jam it right up above this inefficiency, clear the stops, and then that's why you see it repel aggressively. Then it takes out that low, and then it goes to target. But anyone that went short in here or trailed their stop loss, they don't get to have that ticket ride down here. Their ticket gets punched here, and they don't get the prize. They get, if they're lucky, maybe their commission cost covered or a small loss, but they don't make money. But they're frustrated because it goes down here where they thought it was going to go. And then after this, market retraces back up into the inefficiency, trades to the top of the inefficiency here, breaks lower, and everything returns back to what? Algorithmic delivery. Everything goes back to precision price point delivery. But manipulation. And I'm sorry, Wyckoff doesn't fucking teach you that. Okay? It doesn't happen in Elliott Wave. And pitchfork bullshit from Andrews doesn't have it either. Stop trying to talk nonsense. Recognizing characteristics where the price is delivered artificially by AI, algorithmic, versus when someone's in there stirring the pot up. If you can't recognize that, and this is not an easy lesson, I'm honest with you, it's not an easy lesson, and it's something that I can't teach in a book. So when you hear about the books and you're excited about the books and whatnot, just understand that they're limited in their capacity to try to instruct. That's why books aren't really good for teaching trading. They're not. They're absolutely not. Things from other traders' experiences and how they wrestled through them, they are good for books. Technically, how to trade a market, could I have taught the optimal trade entry and silver bullet? Oh, yeah, sure. There's just real straightforward, simple models. But being able to read price action, understanding the difficulties of having a high resistance liquidity run versus a low resistance liquidity run. It's not something that can be easily described. Like, I can show you a static chart, okay? I could show you a static chart in book chapters and everything else and show you before and after. And what was commonly going to be referred to as, well, this is obviously hindsight. So this person has the benefit of hindsight. Now contrast that with where I'm sitting with you live, telling you in advance that this is going to be a problematic, lackluster session. But I told you where I want to see price go. You have no excuse to see that what I was explaining and the difficulty in how price was delivering today, it was already predetermined. I knew it was going to deliver like this. I knew it. And you hear people say, when you hear people say they're trying to predict price, we're not trying to predict price. We're trying to react to price. That's why you're fucking losing. You're trying to react to something that you didn't foresee happening. Like, if you don't know that there's a pothole down that road that you drive down every single day when you go to work, what are you going to do? You're going to hit it every single time. You need to replace your tire and your tie rod and your axle and your struts 6, 7 times in a row before you realize, you know what? I probably should go a different way, or be prepared to go in the other lane, even if it is illegal for a moment when it's safe to do so, to go around that pothole. They're going to say that you have to react to running over that fucking pothole and blowing out your front end alignment. We're not trying to predict the hazard of that pothole. Now contrast that with how I teach. There are times when you're going to be cannibalized by people that are smarter than you, they're in control of price, and you can argue about it all you want, but that's the underlying truth of the matter. And the sooner you align yourself with the thinking like that, it doesn't mean you're a cultist with me. It doesn't mean that you're one of these conspiracy theorists. It means that you're a realist, because you can clearly see it's what's going on. And it gives you the narrative of why price is doing what it does. And when it's not doing it algorithmically, you can recognize it. You can see it. Because the clue is it's losing its precision elements around my PD arrays. That's the benefit. If you start seeing every inefficiency spending a whole lot of time price being inside them, you already know what you're inside of now. You already know that lesson now. But how can I teach that to you just in a couple of static pictures in a book and feel like I've done a good job at it? I couldn't sleep at night saying that I wrote a chapter or two teaching this and feeling like I've done my due diligence and you should have picked up on everything and subtle nuance. It's impossible. You have to see me first tell you what it's going to do and how it's going to deliver and the difficulty it's going to deliver, and then we all watched it today. That's somebody that knows what the fuck's going on. That's somebody that knows what is going on behind the scenes. That's somebody that you can trust as a mentor, because I'm not telling you to send me any money, and I'm doing it for free. And you're watching it work every damn day. So my question to you is, can you recognize that here in this example? I'm not saying you're going to know it in the future, but can you now know when you go through your charts, when you have your first presented fair value gap, or any inefficiency after that one forms, how does price behave at them or while they're in them? Because if you start seeing gaps, the buy side imbalance, sell side inefficiency, or CIBI, vice versa, up close fair value gap or down close fair value gap. That's all it is basically. If price is spending a lot of time or revisiting it multiple times before moving in your favor, you already know now what you're in. So what would you do in that instance? In my opinion, you should immediately drop down to the lowest leverage. If you're going to keep the trade on, go down to the, well, if you're trading the mini, if you have like several contracts on, as soon as you recognize that that's what's going on, slice it down to just one contract. Because number one, you probably would be booking some kind of profit by doing that. You're reducing risk aggressively, which is absolutely good. That's a good thing. That is not you being scared or a pussy, young men. That's you being a risk manager. That's you being aggressive about protecting what's yours. The ladies are going to have no problem taking that exercise on. They go, what? Oh yeah, this is a problem. Let me remove the risk. Or they may say, you know what? To hell with this. I'm going to trade on another setup on another day, and I'll just tape read or paper trade it. Because they're going to be more risk adverse than you are, young men. But the young men that simply just want to be a warrior, what do? Well, in my advice, they would drop it down to the lowest leverage they can have. And if you're trading with micros and you have multiple micros on, go down to just one. That way, you have zero reason to be panicked. Even if it comes back and stops you out, who cares? It took the least from you. If you're going to have something taken from you, wouldn't you like to have a dummy wallet? In today's age, that's what I would have. Keep a wallet in your front pocket that's a slim wallet. That's where you keep your stuff. But if you get held up, you should have a back pocket wallet that's just a dummy one. Never thought about that, did you? Someone hold you up here, here. Put $3 or $4 in there, fold it up, put a column in, make it look like it's something real. I know you guys don't use columns anymore. Just like that, you're taking risks there. Same thing, you're using that same approach. Well, here, you're going to get more than an STD trading in a market like this if you don't recognize the risks. You can get taken out, and you do it to yourself. You keep taking those unnecessary risks, sleeping with these grenades on the weekend, unprotected. Well, you're taking trades and expecting precision in times where it's not likely to happen because of the parameters that were in play this morning. So my question to you is, are you going to take the initiative to start looking at price like this? Are you going to compare every individual day going forward? Recognize the characteristics of that day. Was it under the delivery of high resistance? That means it's having a hard time getting to targets, a lot more deeper retracements, and the way you determine this, it's so visually recognizable by my PD array, the inefficiencies, the gaps. If price is spending a lot of time in them, you are absolutely in high resistance liquidity run conditions. That is not seek and destroy. That is not the chop is real. It just means that you're going to have to submit to more time and then start looking. When you're bearish, you start looking for the sweeps of above old highs. So these conditions create what? Turtle soups. Light bulb just went on, didn't it? Oh, now let's roll it back and I'm going to close the session because we've been at it for a long time today. Here's a high. Judas swing up the upper half. Ideally, we want to see this left open. On a low resistance liquidity run day, this would have never happened. It would have already done enough in here by trading here, failing to go to consequent encroachment, and then rolled out of it. That would have been enough. But because it is spending too much time here, and it worked too many times here, it is already indicating that, okay, this is probably not something. You've already watched me live stream, and I was like, I'm going to take a trade, I'm going to and no, I'm not doing this. And if I would have taken a trade, it would have been a losing trade. And you guys all struggle with the idea, you're hiding your losses, ICT. I know you're hiding them. You don't even know the skill set I'm demonstrating here. Again, I'm proving to you how I can see that it's not favorable. I'm not here trying to impress you with doing executions. I'm teaching you how to keep your money so that we can stay in the game long enough so that way my concepts will yield themselves to you. Turtle soup. Here's a high, runs the buy stops, drops. Relative equal highs. Runs the stops, sells off. High, runs the stops, sells off. High, runs the buy stops, sells off. Do you see what's happening there? That's a characteristic of a high resistance liquidity run market. If you're bearish, look for turtle soup sells. That means look for small little micro shifts in market structure that would be viewed bullishly. But in reality, it's just them taking the short-term buy stops. And they're accumulating the positions that those stops will afford them by being short. And then eventually you'll get to these targets here, and eventually it went even lower there. And this is where we're at now. Now, is this an easy day? Not for a new trader, it's not. Not for someone that's just learning, it's not. But I'm teaching you how, because this is going to happen to you. You're going to be met with this. Caleb's going to see this. You're going to encounter it eventually. And if you don't take this information I've shared today and the recognition of how to determine a high resistance, it's also a lesson for you, Tanya, because sometimes, as proud as I am and as good as you are, sometimes you mislabel days. And I hope you can appreciate this and not be upset by it. But sometimes you misclassify days with seek and destroy, and it's not. It's just simply high resistance. So you're not going to see 2 days of seek and destroy in the same week. That never will happen. It will never, ever happen. But you will have a potential seek and destroy day, and then you'll have a day that's high resistance liquidity. And you'll have it like this, where it's a lot of give and take back and forth. So just be careful with how you're classifying, because when you're saying, and maybe you've done it yourself, I'm just pointing out something to another student, And maybe I should have done it in an email. Maybe I should have done it privately. But I want you to know that this is something that is a stark contrast to seek and destroy. And if you just mislabel it as seek and destroy, what you're trying to do is file it away as, well, it's hard, and I'll just justify by saying it's seek and destroy, when it's technically not. And if I sat back and just let you say it's what it was, or wasn't rather, I'm leaving you in ignorance, and I'm not trying to leave you in ignorance. And I don't want anybody that's listening to you to think that it's seek and destroy either. So what you're many times describing is high resistance liquidity conditions. And the easiest way that you and anyone else that's wanting to learn how to do this can recognize it is when you see your fair value gaps form. Are we spending a lot of time marking price in them? Because that's the clearest indication. That's all I need, and that's all I ever use to determine it. So it's not like I'm hiding anything from you. There's no extra stuff behind the scenes. There's no special PD array or protocol. It's just simply inefficiencies should not be seen with multiple candles laying inside of them over and over and over again, or revisiting them multiple times. That tells you that you're in high resistance liquidity conditions. That means it's going to be a lot more range bound, and then when it explores new lows, it'll retrace back into the range. When it creates the new low here, it gets to our target, it retraces back into the range. And what is it doing? It's setting up highs to run them, creating turtle soup. Drops a little bit, takes out the lows, retraces, takes out the low, retraces one more time, turtle soup. Then the real move. Smaller little turtle soups in here, like that one there. Study it, this high to that high. It's all it's doing is coming back to get any trailed stop losses. That's the nature and what's going on behind the scenes in high resistance liquidity conditions. They're running the stops. That means they're accumulating and building positions because there was not enough orders for them to book with their greed. That's what's going on. So they're not allowing the algorithm to deliver it because the algorithm is not going to spend enough time there for them to build their position. It's just going to be going right to the tick and turn around and go the other direction. So they intervene manually by sending price artificially to these levels so that way those stops get engaged and they take the other side of those stops. And it allows them to build their position on a very narrow range day. So hopefully that's been clear enough. I can't imagine in retrospect now how I could have done it any plainer or simpler because I'm really satisfied with what I shared today. I'm content with it. If there was a way for me to communicate it this way in a book, I would be absolutely content with not having to mention it again in another portion of the book. It's like you've seen it, you watched me explain it. I showed you the difficulties of why the prices were going to be like this today, where it was going to go, the bias. It didn't take out the opening range gap high. And when it was trading up here, I said, okay, that's good. And now we want to see everything is still in play for that sell side to be drawn to. But the main takeaway is this. If you can't recognize these types of days early on, you're going to fall victim to them. You'll be right about where your analysis is going and where the price is going to go, but you won't be in the trade because you're going to get knocked out or scared out of it. And that's happening because of what I'm showing you here today. So I'm going to leave you with this question and I'm going to close the session out. Do you want to trade in days like this because you have time to do so, or your peers, your friends online are trading and they made money, or they are going to try to do something today? Are you chasing that herd mentality, or are you trying to be an apex predator that simply goes out and gets their pound of flesh and they're not in there trying to show what they did? They're just going out there to eat. Because if that's what you're trying to do, and you want to go out there and just make money and have the easiest pathway to that and the least amount of adversaries in front of you preventing you to get to it easily, if you want the hard way, you're going to trade in days like this. If you want the easy ones, you're going to see when the inefficiencies are not being spent with multiple candles and trading back and forth inside them. You're not seeing them hit, respond, and deliver right away. And you're losing the element of precision. Notice that. That is the main takeaways. There's two of them here today. Inefficiencies are spent too much time in, and they revisited multiple times. And the precision delivery is not there. That's not them changing the algorithm. That's just them simply disrupting order flow for that session, for that day. And everything will return back to normal on Monday. Everything will be doing,
until they want to go in here and do it again. But you can't predict all the time when they're going to do it. I can't do it all the time either. The day might start off good, but then I start seeing, oh, wait a minute, it's starting to do something. Go back and watch the previous sessions where I was telling you how to, I can't remember what, maybe you can help me out. I'll mention it in Caleb's video tonight or tomorrow when I do the video for him. It's the video where I'm looking at taking an execution. I'm like, no, I don't like this. No, I don't like this. And I kept myself out of seek and destroy. Oh, there you go. It's Monday. It was an actual seek and destroy. So that skill set came by result of me studying like I taught you today. The lessons that you really need are the lessons where I'm not teaching you how to push a button to get into a trade. It's understanding and recognizing how you're going to lose your ass, how you're going to lose money and not realize how you're losing it so that we can't prevent it from happening again. Whereas now you have a skill set that once you start seeing these inefficiencies, if price is spending too much time in them, you already have your first warning sign. Even if the day starts off with a large range gap, it can fall into this. And then what you need to do is, okay, where is it trying to go technically? Higher or lower? And you had to stick with that bias. So in this case, we were bearish. So every time in that day, you're going to see they're going to take out highs for the express purposes of unseating those short holders that trailed their protective buy stops lower, locking in profits. The market will be manual intervened. They'll run up there. Well, here it is again. Here's a high, runs up, takes out what? That high. And then what does this look like to everybody else? That's a bull flag. That's bullshit. That's what that is. And then it drops and it attacks the lows here. So by recognizing and seeing what the market's likely to do in this type of environment, it at least gives you the ability to say to yourself, is it really worth my time and energy to trade in this? Because I might not be successful. Versus when it's a low resistance liquidity run day, where it's just so easy to fucking make money. It's like, what the hell? This is like candy. Literally like a candy store, going in there and taking positions over and over and over again, long and short, up, down, all over the place, because it's not being manipulated artificially by manual intervention where they go in and they disrupt everything. Left to its own script, price will be perfect. It'll stop to the tick or one tick above where you think it's going to go to afford that entry price. But when you don't see those signatures, that's the surest sign that you need to either move to the sidelines or drop your leverage to the lowest degree you can, or simply paper trade or tape read it. And exercise discipline over yourself. Develop self-control. Be responsible with your actions and know why you're doing something. And if you know that you're going to be forcing yourself to trade like this, that means that you are a gambler. And I promise you this, you are going to blow your accounts. You're going to keep making the same mistakes. You're never going to learn from them. You're going to do the same thing I did for the first 3.5 years. Over and over and over again, never learning your lesson and paying a higher price for your education than you should. You don't have to keep blowing your accounts. You don't have to keep spending needless hours doing dumb shit. These are the lessons that make the money. These are the lessons, because it's not about how much trading you get done today or over the course of the week. It's how much money you have made at the end of the year when you get your 1099B. And most of you don't even know what the fuck that is. That is a statement you get from your broker that says you made money. That's what you get when you do things the right way. And that should be your goal, to make money, not to impress me, not to impress your peers. Because trust me, anything you do, that novelty, that moment of, oh, wow, you may have done something impressive, but they're not going to tell you it was as impressive as it may be to you. So why invite them to it? And why ask yourself to trade in these environments when there's better trading environments? And that's what I teach my students. That is what paid mentorship was. Paid mentorship with ICT, the private mentorship, was teaching them the stark contrast between these types of days and these types of environments, recognizing them, then teaching them over time with skill that you learn and you glean from trading with the low resistance conditions where it's easy to trade. You get really, really good trading in those.
But studying when the market's like this, you will start to see how even in these days you can take setups, but they're far and few between. Whereas a low resistance liquidity run day, I could be buying and selling all day long, up, down, and never have any adversity. In these types of days, if I try to do that, I'll get beat up a little bit. So my question to you is, which one are you going to try to strive to focus on recognizing and only trading in those environments? Do you have the discipline to do that? Do you have the interest in trying to do everything you can to prevent the likelihood of you blowing out because of the difficulty that comes with these types of days? Remember, you're starting out. I'm not saying someone that knows how to trade is going to have difficulty trading this day. I'm saying to you that are brand new or relatively new, you're going to look at this as it's a choppy shit day. Oh, the market's just shit today. It's a price action was garbage today. It's not garbage. You just don't know what you're looking at. And your experience level is so low, you won't be able to navigate in it. But the problem is, some of you simply have a superiority complex. Like, you don't want to be told that this is something you should avoid. And you take it as a personal challenge, like, oh, ICT said that these are hard days. I'm going to go out there and I'm going to trade. Okay. Prove your point, because you're going to prove mine. You're only going to cherry pick what you show. You won't show everything. And why do that? Focus on trading when the days are easy. Absolutely easy. It's like taking candy from a baby, man. It's like so fun. And it makes it easy, fun, and enjoyable. Trading should be enjoyable. If it's stressful, you're doing it wrong. You're over leveraging, you're over trading, and you don't have a model. That's what it's telling you. And I'm trying to do my best by supplying my students with a model that hopefully they can match with their personality, and teaching them how that absolutely you can predict price, you can predict the future, and you're not anticipating to shit. Like, I'm not reacting to anything. I said that wrong. You are anticipating. You're not reacting. If I have to respond to something that I didn't see coming, I can't trust that. That's like a jump scare. Like, my kids have found out several times they almost got jacked in the jaw when they were growing up as teenagers, like jumping out in front of me, and they get solar plexus strike in there and they can't breathe for a couple minutes. It's not because I didn't. You remember that shit? Yeah, it's not that I don't love my kids and I don't want to hurt them, but I train myself. If someone's going to do something like that, it's probably danger. I'm going to neutralize it. So you don't want to do that type of stuff with your trading. You don't want to increase the level of difficulty just for the sake of you want to trade. So hopefully I communicate that. I'm starting to ramble on a little bit now, but I enjoyed today. I enjoyed teaching it today. I enjoyed showcasing it today. I'm hoping, and then you'll let me know in the comments and feedback on Twitter and on the post I put on that I usually do on my YouTube channel. I'll usually put the date up and I'll say, what did you learn today in the live stream? If this has helped you, I'd like to know that. For the jokers to say, I learned nothing, I only see that comment one time and then I block you. I never see you again, because if you wasted your time typing it, I will never waste my time reading your shit again. But I want to know, do you see the advantages of seeing price like this? Because I have seen students literally leave paid mentorship because they couldn't see the value in this. They were too short-sighted to see the value in understanding how to see how things are going to be so much more against you. The level of difficulty that's natural with trading anyway is now been multiplied to a degree that you can't measure until after the day's done, because you don't know what stop they're going to get, because you're brand new. You don't know what they're going to be running for. You don't know how they're going to work with the time of the day and how they're going to run for specific order above or below the marketplace. You don't have that skill set yet. So wouldn't it be advantageous for you to start classifying your day when you journal? Always include that factor. Do you see the imbalances spending too much time holding price inside them? If you see that, then you are in high resistance liquidity conditions. If you don't see that, you are in low resistance liquidity run signatures. That is an easy definition, folks. That is not something hard. It's not an ambiguous thing where it's just, oh, it's a after effect. You can see it real time. You watched me do it now 2 times over live price action, telling you, nope, this is problematic. And it's still the same logic. It's not going to morph into something else. There's no other extra things I'm going to teach around it. You now have it. But are you going to use it? Are you going to help you guide yourself and navigate through price action now knowing this? I don't know. You tell me. That's going to be it for today. I had fun this week. I will do my best to try to come up with some kind of a lecture this weekend and some a review or whatnot. Caleb's video will probably, now that I think about it, I'm not going to do anything tonight. It'll probably end up on his channel Saturday evening around 9 o'clock my time, Eastern time. And then probably earlier in the afternoon, maybe 5 o'clock, I'll have something on my channel in terms of like a teaching lecture or whatnot, maybe some kind of a review. But that's it for this one. I hope you found it insightful. Enjoy your weekend. Be safe. And Lord willing, we'll be back at it again on Monday. Take care.